Good afternoon, everybody. Welcome to today's TIA live stream. We are happy to have you join us for this 3PL market report discussing the Q3 2025 report that just released with our great economist, Mr. Donald Broughton, who will be introducing himself further shortly. We just have a few housekeeping items to get through, and then we will be on our way. You are likely joining us from LinkedIn or YouTube Live. So wherever you are, feel free to comment with your feedback and your questions throughout the presentation, and we would love to hear from you. We're first going to move on to the antitrust statement. Discussion, comments, and presentations during TIA functions must not refer to any past, present, or future rates, prices, or anything related thereto, include any reference to marketing strategies, include any discussion of boycotts of any person, product, or firm, or prohibit or inhibit any members' employees from discussing employment with other member companies. Additionally, things you hear during the meeting that are confidential and private to TIA should not be shared publicly without its prior consent or used against or in competition with TIA. As mentioned, please feel free to comment in the comment section with your question or your feedback throughout the presentation. If you're not comfortable with submitting your question where you are viewing this live stream, feel free to email us at education@tianet.org with the subject live stream with your question, and we would be happy to address it. Additionally, when you want to come back to view the recording of this webinar, you will come back right to where you are currently viewing it, whether that is the LinkedIn event or the YouTube event. So this will be a living event that will house the recording shortly after the conclusion of the event today, for you to go back and watch this recording and give us any questions after the fact. Additionally, if you do have questions after the webinar today, feel free to email us or just comment again in this LinkedIn event or YouTube event, and we will see your question there. With that, I will turn it over to you, Donald. Appreciate it, everyone. Thank you.
Well, thank you, Anthony. Thank you, everyone, for joining in. I just want to kind of start off with what I would say is the penetrating glimpse into the obvious. We started doing this, several decades ago, looking at the economy, looking at transportation companies, and it just seems to me that it's really pretty basic. If goods flows are contracting, the economy cannot be expanding. If good flows are expanding, the economy cannot be contracting. And that's even more true today. And Michael Dell's economy, one of the biggest things he did was change our perception of what inventory levels were needed to be in every industry. First, obviously in the technology industry, but it quickly expanded to everything else. And no one carries any more inventory than they necessarily need to. Over the decades, that has expanded our thoughts, and our study and our work has expanded into looking really at the individual types of goods. And we're going to do a little bit of that today with you to show you what's happening. The simplest example we always use is the amount of semiconductor billings. What the semiconductor billings are going to be before they're announced because of the Asia Pacific air freight volumes. What the housing starts are going to be based upon what the amount of lumber shipped is going to be. As a client of mine in 2006 in London, an old Brit said to me, I was trying to explain to him why the housing industry was crashing in the U.S., and he looked down over his glasses at me and he said, "Oh, Oswald, you all still make houses out of wood." And I said, "Well, yeah, what do you make houses out of here?" "Oh, mostly stone and masonry," he said. I'm like, well, in the U.S., we make houses out of wood. Therefore, if you want to know what housing starts are going to be, you need to just know what lumber shipments are going to be. But so that's the obvious. Nothing moves without logistics. Next slide. It's exactly what's happening in the economy, and that activity is going on. If we're being more efficient in those movement of goods, then our economy is more competitive. We're dependent upon it. The economy is overall dependent upon it, and it's just uh, they're interconnected. You can't separate them. There's been some disparity over the last couple of years, and we're going to get into that a bit. And that our individual income, however you slice it or dice it, disposable individual income, overall personal income, however you want to slice it and dice it, per capita, otherwise, has continued to grow at a heady pace, a pace really 2x what inflation's been going up. And yet we had the largest divergence between that income and spending on goods. And I'll talk about that in length later. And that's been one of the real reasons that the economy has been doing so well. The printed GDP numbers, the income numbers, but the goods flow, the truck tonnage in particular, just hasn't reflected that. But that said, let's talk about the individual. Next slide, please. Now, it's very similar to the second quarter. The third quarter again showed us indications that the freight brokerage and transportation industries had really reached a turning point and were in the process of turning. And so you saw that, we had sequential increases again in the third quarter that were, high single digit as they were in the second quarter, double digit. And then on a year-over-year basis, we're also strong as well. So just volume is a great move. That's very, very encouraging. It was certainly maybe, as we said in our second quarter report, a little early, but indeed now we've had 2 quarters in a row where that pattern has showed up. So that buoys our confidence, as they say. Next slide. If I look at the per shipment invoice values, they're still slightly negative. In part, that's fuel surcharge, but it's really also just the basic bottom line is that volume always leads price. It leads price. This is a basic behavior in every single market out there, whether you're trading freight transportation moves or you're trading corn or soybeans, doesn't really matter. Gold, per shipment, volume leads price. And it's very simple. When you have volumes turning and starting to go positive, the volume turns and starts to go positive before the pricing starts to go up. And then the same thing is true when it turns and starts to go negative. Pricing actually hangs out and doesn't show weakness until after volumes have dropped quite a bit. So right now we're seeing the shipment volumes up the way they are, and we expect pricing to follow. We've been in parts of the spot market, there's some indication that it's actually even better than seasonality, but right, of course, now second and third quarter seasonality, there's improvements in pricing. So we'll see how it lasts, but it should, given the volume increases, continue to improve. Gross margin also, price, volume leads price leads margin, right? Nevertheless, that's what same pattern we saw in the volume and the price and the margin again this quarter. Next slide. If I look at consumer, just go back up to the macro level again. If I look at the consumer income, it doesn't matter where you are, how much you save or how much you spend. You tend to spend lockstep, long-term, 98.5+% of the correlation. If you go back over a long time frame, over 30 years, personal income grows, or consumer income grows, spending on goods grows, retail sales, not including food service, grows. Personal income contracts, spending contracts. Now, so if I look at the consumer income levels in September were more than 54% higher, more than 50%, almost 55% higher than they were in January of 2019. So that's quite an expansion. I will tell you that domestic freight tonnage, while it's above 2019, it's nowhere near 50% higher than 2019. So what's the disconnect? Well, in the recent time, there was a long period of disconnect. It's kind of hard to see in this chart. If you look really closely, there's that period where they disconnect and they seem to have converged again. Personal income is now year to date. In 2000, we don't have November or December yet because the federal government was shut down. But nevertheless, it was through October, it was 5.4% higher than it was in 24, and retail sales were up 4.5%. So finally, that is converging. Next slide, please. So when I look also at another thing that's highly correlated, I could call them the three horsemen, call three musketeers, maybe, if you will. What is happening with retail sales, what is happening with consumer income, and what is happening with import TEUs, import containers. They lockstep move up and down together. Now, this I find this very interesting because there are certain pushes and pulls. Maybe we're making a little bit more of it than we used to at home. So maybe that would lose some of the correlation with import TEUs, but we're still importing things that we need to make those things we're processing here. You know, I say folks all the time, it's a very basic example, but it bears repeating again and again. You know, if you're the head buyer of shoes for Nordstrom's, or you're the head buyer of flat screen TVs for Best Buy or Amazon, you're not the lead buyer of those by accident. You're the lead buyer of those because you've proven yourself over a period of years to be more astute, more prescient, better at knowing what the consumer is going to buy and how many of them they're going to buy. And what it is your channel, whether it's e-tailing or retailing, big box, doesn't matter what you guys can sell. And so import TEUs tend to go hand in hand with retail sales. They're very, 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 purchasing managers are very, very good at figuring out what it is their people are going to buy. Now, does that mean that in any given month, any given quarter, any given year, the guy at or gal buying the shoes for Nordstrom's loses their outlook and they kind of miss the mark? Well, sure, of course. But overall, collectively, they do a great job. So we got consumer sales strong, and I'm going to show you the TEUs. Both of those tell me things that we should continue to expect more spending on goods. All right, let's go one more slide. Yeah, so when I look at the retail sales, the only risk here, of course, is that we're seeing a surge in TEUs, and we're also seeing inventory sales ratios go up. That's the risk, but of course, that's not what happened. What's happened more recently is that retail inventory sales ratios have actually fallen. And if I look at the second quarter and third quarter TEUs coming in to the U.S., people stocking up for the holiday, the fall, back to school, and holiday shopping seasons, TEUs were just 3.3% below the previous all-time peak, which was second quarter, third quarter of 2022. We all remember that. That was hot freight market, right? We're just 3.3% below that. So, and inventory sales ratios have not only not gone up, they've actually declined. Inventory sales ratios have gone from 1.41 to 1 to 1.24 to 1. So that tells me that, again, all those people gauging how many TVs you're going to buy or boots at Nordstrom's or whatever you're going to buy, they have a very positive outlook on what we're going to spend. Next slide. If you look at what I think is very simple math, so those import container volumes, yeah, I understand that some of them go from the port in Long Beach, LA, all the way on to Burlington Northern or Union Pacific, all the way to Chicago or my hometown of St. Louis, Missouri, or Dallas, without ever seeing a truck. But once it gets there, then it's going to go via truck. There is again, lockstep move between the two. And you can actually see in this chart, you can see the back in 23, that began to be that could move where you had import container volumes continue to do a little bit better. And we didn't see as much on the dry van van post because as the import containers moved up, they were doing more things that were more assembly related, more manufacturing related, not related to tech and related to the oil and gas industry, and not related to consumer sales. But that said, that gap is finally starting to close. The other thing that happened there, of course, is we destocked too much. But right now we're seeing the import container volumes. You can see they're just shy of where they were back in 2022. And we're seeing just the beginnings of an improvement, real improvement in dry van load posts. So if I look at dry van load posts up year to date, 7.3%. That's nice. They were up 5.8 in September, up 18.9% in October. And if I look at just 4-week moving average, mid-October through mid-November, which is most relevant for what we're talking about right now, up 22.5%. That's phenomenal. That is a real positive bullish sign. Did Christmas come early? We'll see. Anyway, truckload. Let's go ahead and go to the next one. Let's drill down. On a year-over-year basis, the TIA truckload data still shows the shipments were down, but the invoice per load improved. The gross margin per load improved. That's good. And then if I look sequentially, I get even better example of what's going on. Sequentially, next slide. Sequentially, what we got there is you can see second quarter of 25 was a damn good quarter, and we're right there, basically flat on the shipments level on the truckload side with that third quarter. Gross margin per load's coming up a little bit. That all looks really very nice. If you look at the rolling, next slide, if I look at the next, if I get kind of a rolling average, you can see that the volumes indeed, third quarter versus third quarter last year, you can see the improvement, and you can see the improvement versus second, and then you can see that's an invoice amount per shipment, and you can see the gross margin has bottomed back in the third quarter of last year, and it's improving in truckloads. Next slide. This is the number of quarter shipments, and I've zoomed in the y-axis quite a bit here just to kind of show you the nuances. And we had a little bit of a rush at the end of last year, but we're definitely still moving along. Nice progression, continuing to improve. All right, now what's driving that? Next slide. So here's the main reasons that we've had a disconnect. One of the main reasons we had a disconnect was, and you can see the disconnect in that in the left-hand slide clearly. That is the number of housing starts is the green line, and the mortgage rate is the dotted blue line. When rates were low, housing starts were going through the roof. The slide on the right is the mortgage rate is in green, and the median house price of houses sold is the blue bars. All right. So what happened was very simple. One of the reasons that freight died in 23 is that the millennials stopped buying houses and they started moving into multifamily. And I always say to people, look, I don't mean this misogynistically, but as a bachelor, most of us can live on a mattress in the corner of a room and everything's fine. Then you get a missus, and they make your lives better, but you never knew you needed dust ruffles before. And if you buy a house, you start spending money on those goods. Well, so what happened is that the rates went up. You put those two together. Go to the next slide. And I'd say I've done here in this, the slide on the left is I've said, okay, fine. Let's assume that you're buying the median priced house and you're paying the average mortgage rate in that month. What would your monthly your annual mortgage service cost being just for the interest, just for the principal? And we were running along, under $15,000, $14,500 per year, to buy the median price house and at the average conforming mortgage price. That popped literally to $28,000. It doubled. So when it doubled, you had a bunch of millennials who were thinking, oh, this is our dream house, we can actually afford it, and they were buying them, and then they didn't do that fast enough, and they got away from them, and so they stopped buying and they moved into multifamily, and they're saving their money until they could get a chance to buy that house of their dreams that they've seen. They've noticed it. And that's when you see the disconnect. So when you look at the one on the right, that's where the disconnect happens. And that's the disconnect has continued. Now, is it closing? Yes, it's closing. So here's what we're saying. Now we go back one more slide. Go forward one more slide. Forward. I'm sorry, I said back. So you go back to the housing starts driving demand. You can see the correlation very clearly there. So what we need is, and it looks as if we're beginning to have that, we're having an improvement. What we need is the 10-year treasury to fall below 4, really get down to 3.5, because if 3.5 mortgage, 3.5 10-year will give us a 5.5 mortgage rate, and a 5.5 mortgage rate is when this guy killed before. So getting down to that level or below, I think the housing market takes off again. It takes off strong. Now we have to furnish those houses and fill them up with things that take them from being our house to being our home. And so that's an important factor. Go next slide. So when I look at construction materials versus housing starts, this is last quarter when I showed you this data, and you'll notice 3-week moving average was -4, right? Now go forward one slide. This quarter, we pulled it flat, and they're starting to turn. You can see the shift happening. And that I expect this as it turns and starts to improve. I expect this to get better and better. And that's important for a number of reasons. But first, let's go back to LTL, and we'll talk through it, and then we'll get back to this particulars. Next slide. So LTL is really where we saw the best improvement in many regards. If you look at it on a year-over-year basis, we had 11% change in shipments. We had a huge improvement in gross margin, had a nice improvement in gross margin per load. And, I tell folks this all the time, especially if they're not from the industry. You have to understand that just like volume leads price and price leads margin, truckload tends to lead LTL on the way up and the way down. And I'm going to assume everybody in this webinar understands the mechanics of that, so I'm not going to explain it to you. If you don't understand it, ask me offline or ask me in the Q&A, and I'll explain it. So you saw the next slide. If you look at the improvements sequentially, again, we had a nice improvement both in loads and in invoice amounts and in basis and in margin. So again, LTL is good. And I would note that if I look at the individual companies out there, and I look at it, I tier the groups, and we go into detail on this in the report. But I'm not going to regurgitate, just read the report to you. The smaller firms in particular, logistics firms, found value added by offering LTLs, helping people put together basically small or medium-sized LTL shipments into full-size truckloads and build and give them consolidation opportunities. We saw a lot of volume opportunities, and I think that's really just goes to what it is that freight brokers do and do well. We've had a lot of volatility and a lot of uncertainty added by the tariff and the trade policies, the changes in them, and so as people try to rejigger their supply chains and respond to marketplace conditions that are just ever evolving, you help shipping managers every day facilitate that. And in the LTL industry, your LTL service offerings, in addition to your truckload, have been a great way for you guys to do that. Next slide, please. And you see it again in the gross margin. You see it in the invoice amount per shipment. Let's face it, getting rolling gross margins to over 20% is phenomenal. I don't know about the net. Who knows what the net are? It depends on how well you're managing your business, but to get margins above 20% is outstanding. The next slide. And I just look at the volume that's been done in LTL. You guys are doing more and more in that sector and offering clients alternatives. Let's go to intermodal real quick. Intermodal, we had on a year-over-year basis, still challenging. You really need shift in your price of fuel in order for you guys to get a lot of incremental volume there. Higher the price of fuel goes, the more intermodal you ought to be doing. Lower price of fuel, And that's really very simple in that the shorter and shorter the lengths of haul, the more and more loads are available. And as you all know, the break even point between when it makes sense to go cost effective to go from over the road to uh, rail to intermodal is directly correlated with the price of fuel. It's a linear relationship, but the number of loads available in each of those mile pockets brackets is not linear. They're shorter and shorter the length of haul, the more and more loads are available. There are literally as many loads in the 500 the 500 to 400-mile length of haul as there are in the 500 to 1,000-mile length of haul. So as you get shorter and shorter length of haul, you get more and more. So as we get higher and higher fuel prices, the 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 uh, the amount of intermodal demand just explodes. And I don't like to use words like explode because that's hyperbole, but it's actually true in this case. Next slide. You see, on a sequential basis, you saw intermodal pick up because the price of fuel went up. So you see the volumes go up. They still struggle with margin though, because the invoice amount didn't go up as much, but that's fine.
If everyone could just hold tight, please. I think we lost Donald. If you could please hang on while we sort this out. Thank you, everybody. Apologies for the delay. Hey everybody, thank you for holding. Donald will be joining just in a second here. We thank you for your patience and understanding. Just working on getting Donald back on the call. Thank you all. We appreciate your patience. If anyone has any questions so far on the presentation, please feel free to put them in the LinkedIn comments or the YouTube comments, or email us at education@tianet.org, and we'd love to answer your question. We're planning on continuing these market report webinars, live streams in the future. So do stay tuned to the TIA LinkedIn. Make sure you're subscribed to our daily newsletter to get more information about future live streams such as this one. However, we do also have a great live stream slate for you in 2026. So we're very excited about this new live stream format, and we look forward to continuing offering this great resource to our TIA members. And again, thank you everyone for holding. We apologize for this technical difficulty. We are working on getting Donald back on the call as we speak. Perfect. All good, Donald?
And on.
All right, we're back.
We're back. Bigger and better and brighter, hopefully. You all still there? Fantastic. All right. Let's go to the rolling metrics on intermodal. You look at those, you can see again what we need is really a improvement in higher diesel prices in order to see even better strength there. But nevertheless, we're seeing some decent strength in even in intermodal. That's partially due to prices have gone up a little bit, and also because we have seen the improvement in import container volume. So if I look at the intermodal rolling 8-quarter shipment volumes, next slide, you can see the actual volumes making a nice improvement from first quarter this year. All right, next slide. This is not being moved via truck, but this is important to understand that when you look at the tech economy, not in and out of the Eurozone, which is that lower line. But in and out of the Asia Pacific, I know what's going to happen with semiconductor index, and what's going to happen with semiconductor billings drives not only the tech, the hardware side of the U.S. technology industry, but also the software side. Because when you upgrade your processor, you upgrade your hardware, you upgrade your software immediately thereafter, or maybe it's even as a part of the package deal. So the current improvement we're seeing is steady. You see, we're not quite there, but we're already close to the previous peak of we're less than we're 11% off of the peak of the previous peak. That's damn good. That's damn good. All right. And so if I just zoom in and look at just at next slide, if I zoom in and look just at the Asia Pacific volumes, those are pretty healthy. And as they continue to recover, we get back to that peak. That helps. That's a positive sign of what's going on with our overall economy. One more mode, and then we'll call two more modes, and we'll call it a day. Auto car loads. Auto car loads. We literally could run full out in the U.S. 17.5, 18 million cars a year made by either us or other foreign manufacturers made in the U.S. and still not deal with this period in here. We underproduced cars. And what's interesting is that there's an association between, how old your car is when you replace the car, but there's also an association between housing starts. And let me explain this real quick. If a young couple buys a new house, the chances of them trading at least one of their cars in the next year after buying the new house is triples. The chances of both of them getting new cars within the first 2 years, or trading their cars for newer cars over the next 2 years, more than doubles. And the mechanics of it, I think, are relatively simple to understand. When you're a young couple trying to get ready to get that first house, they're doing everything they can to clean up their credit score. They're not taking on any new loans. They're paying down debt. They're certainly not going out and getting another car and getting another car payment. But then the instant they've got the new house, that's done. And they don't have to worry about that credit score as much. And they realize, okay, yeah, we've been able to make the house payment a couple of months, and we're going to be able. It's a stretch, but we're going to be able to do this, honey. But you know what? Your car, your hoopty really needs to be replaced. And so we'll replace yours, or we'll replace mine first. And then maybe it breaks down. They go to the mechanic and they look at how much they're spending on the mechanic, and they realize, okay, fine. And so we expect car loads, auto, to pick up very nicely once housing starts to. And of course, that's another strong economic activity that we need to see better improvements in. Okay, one more, and then we'll call it a day. One more slide, and then we'll do Q&A. I'll make this more complex if you want me to, but chemical volumes, in order to make or assemble anything of any volume in the United States, you need to consume some chemicals. And chemical car loans have done a great job of predicting what domestic manufacturing is going to be. And you can see that in that period, right post-COVID, we saw the volumes jump through the sky, and we had the highest ISM index literally since the Reagan recovery 40 years earlier. Now, obviously, it plummeted after that as we caught up and we stopped building houses and we stopped and all these different factors. But we have done very, very well coming back since, and it's starting to improve. And that indicates that domestic manufacturing, domestic assembly is also starting to improve. So between container volume, let's just go to the next slide, and I'll just sum it up. So between container volume improving, between consumer income continuing to grow, between dry van load posts in the spot market starting to really pick up nicely, between the volumes and chemicals, all these different other factors, between the Asia Pacific air freight starting to improve, really starting to look nice. All those are very, very bullish. And then when I look at the actual TIA data and look at what you guys are moving, whether it's in the truckload market, whether it's in the LTL market, whether it's intermodal market, or it's the other modes which are offering services where that demand has been very strong. It's not in fuego yet, but it's starting to steadily improve, and the patterns of its improvement are in line with exactly the way markets look when they're turning. So as long as those stay intact and we continue to have data in that pattern, it makes it pretty easy to predict that we're going to have a better 2026, certainly than we had a 2025. And with that, I am open for whatever Q&A you guys might have, and I apologize for the technical difficulties. Don't know what caused it, but nevertheless, we're back live.
Thanks, Donald. Great to have you back. And everyone, just as a reminder, you can submit your questions wherever you see fit. If you're viewing this on the LinkedIn, and if you're viewing this on the YouTube, just submit your comment right there in the comment section, and we would be happy to get to it. As we wait for more questions to come in, Donald, we had our first question from Steve. Thanks, Steve, for your question. Donald, is there a relationship between LTL growth and sales inventory growth, i.e., if COs are focused on COH and lowering inventories, always a push, are they more willing to buy or sell via LTL versus FTL, even at expense of gross revenue or percentage?
That's a damn good question. That's a damn good question. I think it depends upon the value and density of the good, is the answer that I'm going to come up with first off the cuff. The relationships normally is that when you're first going up, you've got things that are going from being large LTL to being full truckload size. Going mid size LTL, small LTL to be large enough LTL you can combine it and make a full truckload stop and drop out of it. And so you see the truckload pickup before you see the LTL pickup, and you see the exact opposite on the way down. But would they do it as you subscribe? I'm going to think about that. I don't know that I have a really good answer, other than if it's very high value, low density type items. So if I'm selling you, the latest greatest sneakers at a Nordstrom's or whatever, Foot Locker, whatever the name is, whatever the customer is, I might send you an LTL shipment as opposed to a full truckload shipment, because I'm making, it's $100, $150 retail per pair of shoes, versus if I'm shipping you sacks of kibble for my hounds. I might wait for the full truckload size, because the value to density is, I get a pallet's only a couple of $1,000 instead of being $10,000 worth of product. I think that's the answer, but let me think about that. That's a good question. I never heard anybody put it that way.
Thanks, Donald, and thanks again, Steve, for that question. No other questions have come in just yet, Donald. Is there any slide you'd like to go back to, or, we don't have to, but if there's anything else you wanted to touch on while we still had some time remaining, or go back to anything, or address any frequently asked questions, Donald, that would be great.
Well, thank you. We certainly tried to address what I get most often, which is, the most glaring is, I'll talk about what's happening with the consumer and the growth of their income. And well, then why aren't they spending it on goods? Right. And I think that's, has a lot to do with household formation. But I will admit that it's also part of it is also just a change in our culture. And that, I see it in my own children's behavior, my own son's behaviors. And I also just see it in the way in what's happening in our society. Things good are becoming higher in value and lower in density in their very nature. And some of them are actually jumping to infinite, So there's things that, when I was a kid, we got to get a new game to play. We got a box, right? And you open it up and it said, new version of Risk or Monopoly or whatever, right? And today, Christmas time, kids are going to get a new game. There's no box. It's just, it's an app that or it's a game that's downloaded. That software comes along. There's no box accompanying that. There's plenty of other examples like it, but part of it is household formation, but part of it is also just the nature of the change in the and what we're doing. I would note that, and I didn't include it in this presentation. I will, and maybe I should do so in future presentations. The amount of investment we're making domestically in local manufacturing facilities. So we are on pace to basically invest $20 billion a month, incremental investment by private, not public, by private, in domestic manufacturing and assembly plants. We're not spending. Businesses are not making the decision to spend another 20 billion on top of another 20 billion on top of another 20 billion every month in domestic manufacturing, and understand that that was more like 4 billion a month prior to COVID. So maybe 5 billion a month. So we're running at a pace of 4 to 5 times what we were running pre-COVID. We're not making that investment by accident. That means we're going to make more things here. And as we make more things here, we're going to see a multiplication of ton miles domestically as you bring all the raw materials into those plants and all the finished goods out of those plants. And that was also happening. Will tariffs encourage that? Yes, but it was happening, or actually beginning to happen already before tariffs. Is happening because of the technology and because cheap BTUs from fracking and a host of other reasons that make the U.S. a better place to make things than it's ever been in a very, 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 very long time. So, do we have anything else? If not, I want to thank you all for tuning in. Anthony, do we have anybody else that's been able to get through this platform?
Donald, not yet. No further questions, but everyone, just as a reminder, when you come back to review this recording, feel free to drop your question again in the comment section, and we will come back and get back to you.
We'll get back with you.
As always, if you have questions about accessing the TIA Q3 market report, you can email us at education@tianet.org for assistance. And also stay tuned for more webinars just like this one.
And we apologize for the tech issues. Anthony, let's do a check on this. We had changed a different platform, and we'll check my computer, your computer, and the platform and see where the problem was, and whatever created the problem, it'll get fixed. So we don't do this again next quarter. But you all have a happy holiday and prosperous new year, and thank you for your time and attention.
Thank you, everyone. Appreciate it. Thank you for your time, Donald. We will see you in the new year, everyone. Thank you. Take care, everyone.